Good afternoon, traders. Welcome one, welcome all to the all-exciting FOMC stream. It's the FOMC stream. All right, so what has just happened about a minute ago is that the FOMC released the minutes from the meeting that they had yesterday and today. So at this very moment, the algorithms have come out to play. They are reading that text and reacting to it instantaneously. They are buying and selling stocks. They're buying and selling futures. They're buying and selling options too. They are just buying and selling all over the place. So we expect that there will be a lot of volatility for about the next 15 minutes or so. Right? The market may make a big move up. It may make a big move down. It may completely retrace. It may start going in one direction and never come back. I mean, just about anything can happen when there's this much activity as a result of those FOMC minutes being released. Okay? One thing that I like to make note of is it is very common if the market does start to pick a direction. If it does start to move lower or it does start to move higher in the first 15 minutes, it will often retrace that once Powell comes out and starts speaking. He'll be coming out in about 30 minutes. And so once he comes out and starts talking, a lot of times it completely retraces the first sort of emotional reaction move that the market got when this minutes came out. Okay. So how do we trade this, Charles? Well, right now it's gambling. There's no two ways about it, folks. If you're going to enter a trade for the rest of the day today, it is a gamble. The market is going to move very, very quickly in a very, very volatile range. So the best way to do it is to first and foremost sit on your hands and wait till you feel confident the market has momentum one direction or another. If it starts to break higher and it's going and it's going and it's going, it's better to enter somewhere after the break once the momentum is confirmed and just grab little bites, little pieces on the way up, rather than trying to guess right now that it's going to go up and stay in the trade. Okay, this market can reverse in a second. So if you get in a trade, either direction, and the market starts to move in your favor, say you go long, boop, I'm long, market starts to move in my favor, I will instantly move my stop above my entry and take the risk off the table. I'd rather the market come back down and stop me out for like a point of gain than to keep my stop wide and then I come down and take out a loss. Okay? So if you're going to gamble, gamble smart. And that is to say, enter a trade, move your stop as soon as you can, and pray to the money gods that the market moves in your favor. As far as what we've had so far today, the market has just been rotating sideways. It's just been balancing inside the overnight range. I will make note of the fact that this giant node of liquidity up at 5,100 showed up here the minute they tried to break out of the initial bounce. When they tried to take the market lower in the F period this morning, the market makers said, no, you go. Whenever we see very, very large pools of liquidity above and below price like this, it significantly increases the odds of chop, of sideways, of grind. And so we had this big node that's been here all week, down here at the lows. And the fact that as soon as the market started to move to it this morning, they put this one up here meant they did not want the market to run away to the downside. So we got a lot of balance. It is two-sided. Anything can happen. We've now filled the gap from yesterday. So let's sit back, relax, and enjoy the show. Right now I'm seeing two-sided volatility. No momentum one direction or to other. It's a chop zone. Do. We got 54 people hanging out. If you have not yet, please smash that thumbs up button. Those thumbs up will help tell other people to come check out the stream. The more people watching, the more people will want to watch. Also say hello in the chat. I see 200 dogs is here. DNK. DNK says, what's the call? Are we going up 100 points or down 100 points? DNK, you forgot the third option, which is we go nowhere and the market closes right at the opening price. If I had to guess, those that are in the brigade know I was talking about this morning. My conspiracy theory-esque mind makes me think we're heading up towards yesterday's high, and that all of this selling yesterday was just to get people short so they could squeeze them. That's just a guess. There's no real data behind that. It's just a feeling. I got a feeling. Hoo, hoo. So we'll have to wait and see. Good afternoon to Will, Mr. Ree, Argit, Raphael, Grizzly Bull, and Branko. Welcome, welcome. All right, the survey is out in the chat, completely anonymous. We don't know who votes what, but I'd love to hear your opinion. Do you think that Jay Powell, when he starts talking at 2:30, is going to take this market higher, lower, or absolutely nowhere? And we're going to close right about where we are right now near the opening price. Which do you think is going to happen? I hope my conspiracy theory isn't affecting the survey results. We got 57% of you saying you think the market's going to go higher. A lot of people haven't voted. Just let us know. What do you think? Even if it's a guess, is the market going to go up, down, or go nowhere? Once Powell starts to speak. I'd love to know what the groupthink is. DNK says, I think lower, as a lot of people had started talking about rate cuts, but Powell and the Fed speakers have not indicated at all about rate cuts, only if they are going to increase or not. That's an interesting perspective. A lot of people started talking about rate cuts. Yeah, I definitely don't think they're going to cut. I mean, I'm just guessing. I have no idea. But I don't think they're going to cut. I have a feeling he's going to say exactly the same thing that he did last time, which is like, inflation's getting better, but it's not gone, so we're going to keep doing nothing and be data dependent. And so then I start to ask myself the question, if people going into this FOMC meeting have been more bearish or have been more bullish, and he doesn't say anything exciting, how will the market react? Oh boy, they just took out somebody for 95 contracts. Someone was really hoping that liquidity was going to hold. And they got themselves squeezed. $59 people hanging out, 27 likes. I get it. You guys hate me. I'll take it. Grizzly Bull says, Big Papa Powell wants a pump. Oh, he wants a pump. Papa want a pump. That goes without a doubt. Wait, that sounded gross. I didn't mean it that way. Well, this has got to be about the most exciting FOMC minute release I've ever seen. They had all the fun yesterday. Yesterday got to have all the fun. Cooper says, I think he'll say more data is needed before a rate cut. You're welcome, Coop. Thanks for joining. Yeah, my whole thing is it doesn't matter what he says. My whole thing is what matters is how the market has it priced in. Because if speculators have speculated, they got to unspeculate based on whatever he says or doesn't say. And that tends to have the more violent reaction. And I would say as of now, the market is not showing its hand at all. I mean, it's like 50-50 probability from here. Scott says he could say that they're cutting rates, but in the time until cut is official, he'll still be looking for more data. No, because him saying they're going to cut rates is the same thing as them cutting rates. He's talked about this in interviews, that nowadays, because they're so public about everything they're going to do, oftentimes they don't actually have to do a thing. They can just talk about doing a thing and the market will react to it. And then they don't ever have to do the thing. So I think if he wanted to, have an effect on price, he would just straight up come out and say it. Scott says, pump higher to fill gaps, then sell off end of day. Well, it depends how you measure a gap. If you measure a gap the way I do, it was just filled. I measure a gap based on the previous day's low, and we just touched it in the J period. So that was your pump, if your theory is correct. I have found in watching FOMC meetings in the past, generally one of two things happens. Of course, anything can happen. Anything. But generally, either it just bounces around in a range and it just keeps going up and down, going nowhere, or it picks a direction and it starts fucking pumping. And if it picks the direction and it starts going, it can make a very large move. And it's one of those moves where it constantly feels like it's going to run out of steam. And then it just keeps going. And you're like, oh, this thing's it's definitely running out of steam. And then it just keeps going. Or vice versa. But the idea is once it picks a direction, it will keep going until he's done talking. That is obviously the most ideal scenario for a day trader. Because as I said, you can grab little bites along the way. Thank you, sir. May I have another? Thank you, sir. May I have another? Thank you, sir. May I have another? Scott says I was being facetious. Scott, you know better. Don't be trying to be cheeky in the chat. Because if I don't catch the joke, I'm gonna take it serious. All right, I'm gonna take that real serious. He says he's talking about Q stocks, their gaps on the daily. Again, I don't think any of it matters. You know, everything is so tied together that whatever reaction happens, market goes up, market goes down, or market goes sideways, that's what's going to happen on every stock. Design Knob says, hopefully he uses every tool available to him. Well, we should hope that he's data dependent and using all the tools available to him. By the way, welcome back, Design Knob. Good to see you. DNK says, I already had my 10-point gamble, had a limit order short on the gap fill, then closed for 10 points. Well, that now in hindsight looks like a brilliant trade. But I would have been nervous at the moment since it poked up there so quick. All right. Well, things generally calm down here about 10 minutes before Powell comes out to speak. I know they've been calm this whole time, but they normally really slow down here. And when Powell comes out in 10, things should hit the fan. We will, of course, watch that live here together. But now it's just a waiting game. Ed says, I think Powell has AI now. Do you mean you think he is AI now? Like the video we're going to watch isn't a real man? How crazy would it be if they just created an AI and like gave it control of the Fed? They were like, we can't trust human beings and their emotional reactions to things. And so we're just going to let a computer decide from now on monetary policy for the United States. That would be nuts. He says, no, with his tools. Oh, I'm sure he's using AI. Particularly the people that have to crunch the spreadsheets like crazy. No doubt about it. Frito says, I say just end the Fed entirely. That is a very complicated idea. Easier said than done. So you say to me, Charles, why not just go back to the gold standard? We don't have enough gold. Too much debt. Not enough shiny metal. Can't do it. Design Knob says, I wonder if the Murderbot uses AI. Design Knob, you're showing your age. We don't even talk about Murderbot anymore because Murderbot is all day, every day now. The type of highly volatile machine-driven moves that used to just happen in the last 10 minutes happen all throughout the day, every day now. So we don't even call it the Murderbot anymore. We just call it the market. Scott says, issue is AI already told them our fiscal policy is busted for 5 years. AI said create a new economy to correct. Create a new economy for the whole world? That sounds like some AI shit right there. Will require more NVIDIA chips. Oh, yeah. And electricity. Oh, so much electricity. What's crazy is how much AI is going to change what gives one nation an advantage over another nation in terms of economics. It used to be very material, right? Like what raw materials were available in your nation? How easy is it to move things around? Do you have waterways? Do you have railroads? Do you have access to the ocean? Do you have lots of ports where you can move goods in and out? And in the decades to come, it's going to become about your infrastructure in terms of compute. So how many data centers do you have? How many giant warehouses full of computers? And how much electricity can you produce in order to run those data centers? So you don't need to have oceanfront property anymore. But you got to have lots of compute. All right, we're back inside yesterday's range. That is a little bit bullish to see. Obviously, it's hard to make any speculation based purely on technical analysis when we're 4 minutes from Papa Powell coming on out. But I would just say it is bullish that we're able to get back into yesterday's range and will likely lead to a little bit of short covering, such that you see with the volume dots on the book map. If you are just joining us, please hit that thumbs up button. I sure would appreciate it. And vote in the survey in the chat. Let us know. Where do you think the market's going to go once Papa Powell starts to speak? Higher, lower, or nowhere? I'd love to know the group think. You got 2 minutes to let us know. Look at that. More short covering. Squeezing those sellers. Wonder how many sellers are waiting above that overnight high. Wonder how many sellers are waiting above that base of spike down. Someone's doing something. The moment that they let it back up into yesterday's range, the liquidity, that monster wall of liquidity, got a little bit thinner down there at 62. At 49.62. The game's afoot, folks. The game is afoot. 7 Mile Reach says the queue is filling some single prints. Let's take a look. We got 2 minutes to Papa Powell. I was trying to fill the gap. So they haven't even gotten a gap fill on the queue yet. Got another about 5 points to the upside. Man, both markets closed on the low tick yesterday. That is so rare. Makes me cough, cough, feel like it's a conspiracy, cough, cough. And they didn't really want to take the market lower. It was all a game. All right, there's the gap filled on the queue. All right, I'm going to switch over to the conference. Papa Powell should be coming out any moment now. I will stop talking once he starts. But if I see anything technical analysis-wise while he's speaking that catches my attention that I think is worth mentioning, I will be sure to mute him and let you know what I think. For those of you that are new to trading the FOMC, I'll just give you my rundown of how it works. First off, the market often makes a move and fakes out another direction, so don't assume it has to keep going higher just because it's going higher now. But if it continues, if it just keeps melting in one direction, it will often keep melting until he's finished talking in whatever that direction is. So once you feel like you see that's what's happening, look for trades in that direction, buy support. Don't FOMO in at the high, but on a pullback, buy support. As soon as you're profitable, move your stop above your entry. No reason to take on unnecessary risk. These markets can flip and reverse at a single word, at a facial expression that this man makes. Anything could happen. Good luck, and let's enjoy the show. Oh, let me finish the survey. Survey says 58% think the market's going higher, 25% think it's going low or think it's going nowhere, and 16% think it's going lower. You know what that means, kids. This market's about to sell off. Only 16%? Oh, yeah, we're going down. I'm just kidding. Let's see what Powell says.
To achieving our employment and inflation goals have moved toward better balance over the past year. However, in recent months, inflation has shown a lack of further progress toward our 2% objective, and we remain highly attentive to inflation risks. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.6% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, was 3.1% in the first quarter, as strong as the second half of 2023. Consumer spending has been robust over the past several quarters, even as high interest rates have weighed on housing and equipment investment. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. The labor market remains relatively tight, but supply and demand conditions have come into better balance. Payroll job gains averaged 276,000 jobs per month in the first quarter, while the unemployment rate remains low at 3.8%. Strong job creation over the past year has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year and the jobs-to-workers gap has narrowed, but labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer-run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The inflation data received so far this year have been higher than expected. Although some measures of short-term inflation expectations have increased in recent months, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to returning inflation to our 2% objective. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings, though at a slower pace. Over the past year, as labor market tightness has eased and inflation has declined, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect that it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. In particular, and as I noted earlier, readings on inflation have come in above expectations. It is likely that gaining such greater confidence will take longer than previously expected. We are prepared to maintain the current target range for the federal funds rate for as long as appropriate. We're also prepared to respond to an unexpected weakening in the labor market. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We will continue to make decisions meeting by meeting. Turning to our balance sheet, the committee decided at today's meeting to slow the pace of decline in our securities holdings, consistent with the plans we released previously. Specifically, the cap on Treasury redemptions will be lowered from the current $60 billion per month to $25 billion per month as of June 1. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we're leaving the cap on agency securities unchanged per month, and we will reinvest any proceeds in excess of this cap in Treasury securities. With principal payments on agency securities currently running at about $15 billion per month, total portfolio runoff will amount to roughly $40 billion per month. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach its ultimate level more gradually. In particular, slowing the pace of runoff will help ensure a smooth transition, reducing the possibility that money markets experience stress and thereby facilitating the ongoing decline in our securities holdings that are consistent.
Excuse me. Okay, so real quick, I just wanted to mention, it does feel like the market is picking its direction and it wants to go higher. That is bullish to see. I'm curious to see how it handles, and it's literally happening while I talk. I'm curious to see how it handles this liquidity up here at 82. Does it just blow right through that, or does that act as resistance? If it blows right through, we are likely to get continuation higher. If it acts as resistance, a pullback down towards the opening price. Can they keep the momentum going? They likey what Papa Powell has to say so far.
Thank you. I look forward to your questions.
Thank you. Howard Schneider with Reuters. A question to follow up, if I could. Do you consider the current policy rate still, are you confident that it's sufficiently restrictive to get inflation back to 2%?
So I do think the evidence shows, pretty clearly that policy is restrictive and is weighing on demand. And there are a few places I would point to for that. You can start with the labor market. So demand is still strong, the demand side of the labor market in particular, but it's cooled from its extremely high level of a couple of years ago. And you see that in job openings. You saw it, more evidence of that today in the JOLTS report, as you'll know. It's still higher than pre-pandemic, but it has been coming down both in the Indeed report and in the JOLTS report. That's demand cooling. The same is true of quits and hiring rates, which have essentially normalized. I also we look at surveys of workers and, surveys of workers and businesses and ask workers, are jobs plentiful, and ask businesses, are workers plentiful? Is it easy to find workers? And you've seen that the answers to those have come back down to pre-pandemic levels. You also see in interest-sensitive spending like housing and investment, you also see that higher interest rates are weighing on those activities. So I do think it's clear that that policy is restrictive.
Sufficiently restrictive, I guess.
So I would say that we believe it is restrictive, and we believe over time it will be sufficiently restrictive. That will be a question that that the data will have to answer.
So as a follow-up, if inflation
Pardon me.
continues running roughly sideways as it has been, the job market stays reasonably strong, unemployment low, and expectations are anchored and maintained, would you disrupt that for...
Expectations are not anchored?
Or anchored.
Or anchored.
Stable, roughly. Would you disrupt that for the last half point on PCE?
I don't want to get into complicated hypotheticals, but I would say that, we're committed to retaining our current restrictive stance of policy.
Okay, so getting above the base of the spike sets us up for another set of short covering, another move to the upside, because a lot of people who shorted at the end of the day on yesterday, well, there it is. There's your short covering. Twice before I could even say it. So the next note of liquidity of interest is 5,100. Same as before. If we instantly push right through it, look for further upside continuation. If it acts as resistance, look for a pullback. Damn, this is happening fast. Can't even talk.
Our policy focus is really what I just mentioned, which is...
So let me introduce you to short covering, folks. Short covering inside yesterday's range. Short covering at the base of the spike.
Persuasive evidence that our policy stance is not sufficiently restrictive to bring inflation sustainably down to 2% over time. That's not what we think we're seeing, as I mentioned. But that's something like that is what it would take. We'd look at the totality of the data to answer that question. That would include inflation expectations, and all the other data too.
Would that be like a reacceleration in inflation?
Well, I think, again, the test, what I'm saying is if we were to come to that conclusion that policy weren't tight enough to achieve that, so it would be the totality of all the things we'd be looking at. It could be expectations, it could be a combination of things, but if we reach that conclusion and we don't see evidence supporting that conclusion, that's what it would take, I think, for us to take that step.
Chris?
Thank you, Chris Rugaber at Associated Press. You didn't mention the idea that rates are at a peak for the cycle, and didn't mention the idea that it might be appropriate to cut rates later this year, as you have at previous press conferences. So has the Fed sort of dropped its easing bias? Where are you standing on that?
So on, let me address cuts. So obviously, our decisions that we make on our policy rate are going to depend on the incoming data, how the outlook is evolving, and the balance of risks, as always. And we'll look at the totality of the data. So I think, and we think, that policy is well positioned to address different paths that the economy might take. And we've said that we don't think it would be appropriate to dial back our restrictive policy stance until we've gained greater confidence that inflation is moving down sustainably toward 2%. So, for example, let me take a path. If we did have a path where inflation proves more persistent than expected and where the labor market remains strong, but inflation is moving sideways and we're not gaining greater confidence, well, that would be a case in which it could be appropriate to hold off on rate cuts. I think there's also other paths that the economy could take which would cause us to want to consider rate cuts, and those would be, two of those paths would be that we do gain greater confidence, as we've said, that inflation is moving sustainably down to 2%, and another path could be, an unexpected weakening in the labor market, for example. So those are paths in which you could see us cutting rates. So I think it really will depend on the data. In terms of peak rate, I think really it's the same question. I think the data will have to answer that question for us.
Well, and could you just follow on the path where you might not cut? Is that, you mentioned that it would be inflation persistent. Is inflation, would that be the key data in making that decision, or could you expand a bit more on that? Thank you.
Again, we've set ourselves a test that for us to begin to reduce policy restriction, we'd want to be confident.
Okay, so it's hard to feel confident making this statement since there's so much volatility here, but they just flipped the order book. That resistance we've been waiting to test at 5105 just became support, so that increases the odds of further upside continuation. I can't believe I'm saying it, but yesterday's high is in play. My conspiracy theory was correct. I'll wait for you to clap.
Has the easing in financial conditions since November contributed to the reacceleration in growth? And do you now expect a period of sustained tighter financial conditions will be needed to resume the sort of disinflation the economy saw last year?
So I think it's hard to know that. I think we'll be able to look back, from down the road and look back and understand it better. If you look at, let's look at growth. Really, what we've seen so far this year in the first quarter is growth coming in about consistent with where it was last year. I know GDP came in lower, but you don't see an acceleration in growth. I mean, the thought would be that financial conditions loosened in December, and that caused an uptick in activity, and that caused inflation. Presumably that's or tightening in the labor market. You don't really see that happening. What you see is economic activity at a level that's roughly the same as last year. So, what's causing this inflation, we'll have a better sense of that over time. I don't know that there's an obvious connection there, though, with the easing of financial conditions. In terms of tightening, you're right. I mean, rates are certainly higher now and have been for some time than they were before the December meeting, and they're higher, and that's tighter financial conditions, and that's appropriate given what inflation has done in the first quarter.
You've said in the past that stronger growth wouldn't necessarily preclude rate cuts. I wonder, would continued strength in the labor market change your view about the appropriate stance of policy if it was accompanied by signs that wage growth was reaccelerating?
So I just want to be careful that we don't target wage growth or the labor market. And remember what we saw last year: very strong growth, a really tight labor market, and a historically fast decline in inflation. So and that's because we know there are two forces at work here. There's the unwinding of the pandemic-related supply side distortions and demand side distortions, and there's also monetary policy, restrictive monetary policy. So I wouldn't rule out that something like that can't continue. I wouldn't give up at this point on further things happening on the supply side, either because we do see that companies still report that there are supply side issues that they're facing, and also, even when the supply side issues are solved, it should take some time for that to affect economic activity and ultimately inflation. So there are still those things. So I don't like to say that either growth or a strong labor market in and of itself would automatically create problems on inflation, because of course it didn't do that last year. You ask about wages. We also don't target wages. We target price inflation. It is one of the inputs. The point with wages is, of course, we like everyone else like to see high wages, but we also want to see them not eaten up by high inflation. And that's really what we're trying to do, is to cool the economy and work with what's happening on the supply side to bring the economy back to 2% inflation. And part of that will probably be having wage increases move down incrementally toward levels that are more sustainable.
Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. You talked about needing time to gain more confidence that inflation is sustainably moving back down to 2%. It's May now. Do you have time this year to cut 3 times, just given the calendar?
Yeah, I'm not really thinking of it that way. What we've said is that we need to be more confident, and we've said, my colleagues and I today said, that we didn't see progress in the first quarter, and I've said that it appears then that it's going to take longer for us to reach that point of confidence. So I don't know how long it'll take. I can just say that when we get that confidence, then rate cuts will be in scope, and I don't know exactly when that will be.
And with hindsight, are there any signs that you can look back on now, looking at the reports from January or February or March, that suggested something more worrying than just expected bumpiness?
Not really. So I thought it was appropriate to reserve judgment until we had the full quarter's data, until we saw the March data. And so take a step back. What do we now see in the first quarter? We see strong economic activity. We see a strong labor market, and we see inflation. We see 3 inflation readings. So I think you're at a point there where you should take some signal. We don't like to react to 1 or 2 months' data, but this is a full quarter, and I think it's appropriate to take signal now, and we are taking signal. And the signal that we're taking is that it's likely to take longer for us to gain confidence that we are on a sustainable path down to 2% inflation. That's the signal that we're taking.
Steve.
Yeah, Mr. Chairman, if I could, Steve Leisman, CNBC, if I could follow up on that. What particular areas were sort of temporary or blips in the inflation data in the first quarter, and what's the dynamic by which you expect them to work out in the coming months and quarters?
Yeah. So we will.
Did you guys hear what Powell just said? The new data is that we just have to wait for more data. The new signal is we're not sure. We need to wait. Anyway, I just wanted to say, as we start to re-enter the single prints from yesterday, that is above 51.16, it increases the odds we will backfill those single prints, getting us back to 51.26. The base of those single prints, 51.26, is likely to act as resistance. But again, if we get above it, same as getting back in yesterday's range caused short covering, same as getting above the base of the spike caused short covering. If we can, and it's a big if, but if we can get above 26, that will cause more short covering. So it does feel like it's running out of steam. We're starting to need to bring in new buyers. But as long as the momentum continues, the momentum will continue.
Services inflation, given where market rents are, those will show up in measured housing services inflation over time. We believe that it will. It looks like that there are substantial lags between when lower market rates turned up and for new tenants, and when it shows up for existing tenants or for in housing services. So,
If I could just follow up, is there a bit of a contradiction in the idea that you are reducing quantitative tightening, which is sort of an easing, while you're holding rates steady at a restrictive rate to try to slow and cool the economy and inflation? Thank you.
No, I wouldn't say that, no. I mean, the active tool of monetary policy is, of course, interest rates. And this is a plan we've long had in place to slow, really not in order to, to provide accommodation to the economy, but to be less restrictive to the economy. It really is to ensure that the process of shrinking the balance sheet down to where we want to get it is a smooth one and doesn't wind up with financial market turmoil the way it did the last time we did this, and the only other time we've ever done this.
Craig.
Torres from Bloomberg. Two questions. First, simple one. Given the run of data since March, has the probability in your mind of no cuts this year increased or stayed the same? That's the first question. Second question. Chair Powell, you joined the board in 2012, and I'm sure you remember, as I do, what the jobless recovery was like. Lawyers, accountants, all kinds of highly qualified people who couldn't get jobs. And given your history there, I wonder if there's an argument for being more patient with inflation here. We have strong productivity growth. That's helping wages go up. We have good employment. And so it seems to me there's a lot of hysteria about inflation. I agree, it's, nobody likes it, but is there an argument for being patient and working with the economic cycle to get it down over time? Thank you.
So on your first question, I don't have a probability estimate for you, but all I can say is that, we've said that we didn't think it would be appropriate to cut until we were more confident that inflation was moving sustainably at 2%. We didn't get, our confidence in that didn't increase in the first quarter, and in fact, what really happened was we came to the view that it will take longer to get that confidence. And I think I think it's, the economy has been very hard for forecasters broadly to predict its path, but there are paths to not cutting, and there are paths to cutting. It's really going to depend on the data. In terms of the employment mandate, to your point, if you go back a couple of years, our sort of framework document says that when you look at the two mandate goals, and if one of them's further away from goal than the other, then you focus on that one. It actually, it's the time to get back there times the times how far it is from the goal, and that was clearly inflation. So our focus was very much on inflation, and this is what we referred to in the statement. As inflation has come down now to below 3% on a 12-month basis, it's become we're now focusing the other goal, the employment goal, now comes back in to focus, and so we are focusing on it. And that's how we think about that.
Claire.
Claire Jones, Financial Times. Thanks a lot for the opportunity to ask the questions. Just to go back to the answer before the previous one, it seemed to suggest that you think the likeliest path of inflation is one that's going to allow you to have a situation where rates are lower at the end of the year than they are right now. It'd be good if you could just confirm whether or not that's a correct reading. And the Q1 GDP print has led to some to start mentioning the term stagflation with respect to the US economy. Do you or anyone else on the FOMC think this is now a risk? Thank you.
Yeah, I'm not dealing really in likelihoods. I think there are paths that the economy can take that would involve cuts, and there are paths that wouldn't. And I don't have great confidence in which of those paths. I think I would say my personal forecast is that we will begin to see further progress on inflation this year. I don't know that it will be sufficient. I don't know that it won't. I think we're going to have to let the data lead us on that. In terms of your second question was stagflation. I guess I would say I was around for stagflation, and it was 10% unemployment. It was high single digits inflation. Right now we have and very slow growth. So right now we have 3% growth, which is pretty solid growth, I would say, by any measure, and we have inflation running under 3%. So I don't really understand where that's coming from. And in addition, I would say most forecasters, including our forecasting, was that last year's level of growth was very high, 3.4% in, I guess, the fourth quarter, and probably not going to be sustained and would come down. But that would be our forecast. That wouldn't be stagflation. That would still be to a very healthy level of growth. And of course, with inflation, we will return inflation to 2%, and that won't be. So I don't see the stag or the inflation, actually.
Michael McKee from Bloomberg Radio and Television. The vice chair of the FOMC said recently that he's willing to consider the idea that potential growth has moved up, and of course he's Mr. Potential Growth, our star. Do you share that view, and would that imply that maybe policy isn't tight enough?
So I think I would take that question this way. We saw a year of very high productivity growth in 2023. And we saw a year of, I think, negative productivity growth in 2022. So I think it's hard to draw from the data. The question is, will productivity run? There are two questions. One is, will productivity run, persistently above its longer run trend? I don't think we know that. In terms of potential output, though, if that's a separate question. We've had what amounts to a significant increase in the potential output of the economy that's not about productivity. It was about having more labor, frankly, both through, in 2023, both through participation and also through immigration. So we're very much like other forecasters and economists getting our arms around what that means for potential output this year and next year and last year, for that matter, too. So I think in that case, I think you really do have a significant increase in potential output. But you've also got you've got more supply, but those people also come in, they work, they have jobs, they spend, so you've also got demand. So it may be that you get more supply than you get demand at the beginning, but ultimately it should be neither inflationary nor disinflationary over a longer period.
Well, you said earlier that at this point you're not really considering rate increases. If growth is higher, but you're not considering rate increases, does that imply that you're more worried about causing the economy to slow too much than you are about inflation taking off again?
No, I think we believe our policy stance is in a good place and is appropriate to the current situation. We believe it's restrictive, and our evidence for that I went over earlier.
Single prints inside a single prints, y'all. Bum, 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 ba, ba, bum, bum, ba, da, da, da. Y'all ready for this? All right, so 51.25. This is the last defense the sellers have based on yesterday's range. Either they smack the market down right here, right now, or we're going to start getting short covering and be back at yesterday's high in no time. Let's see what happens. Do the sellers start to pile on and defend 25?
Need a rate hike to get from 3 to 2% inflation. So was there any discussion about a rate hike in today's meeting? And are you satisfied with 3% inflation for the rest of the year?
Well, of course, we're not satisfied with 3% inflation. 3% can't be in a sentence with satisfied. So we will return inflation to 2% over time, but over time. And we think our policy stance is appropriate to do that. So if we were to conclude that policy is not sufficiently restrictive to bring inflation sustainably down to 2%, then that would be what it would take for us to want to increase rates. We don't see that. We don't see evidence for that. So that's where we are.
Was there a discussion about a rate hike at all?
So the policy focus has really been on what to do about holding the current level of restriction. That's part of the policy. That's where the policy discussion was in the meeting.
Yeah, I wanted to follow on the 3%. Is there a time frame of persistent inflation that would trigger a rate hike?
There isn't any rule. You can't look to a rule. These are going to be judgment calls. Clearly, restrictive monetary policy needs more time to do its job. That is pretty clear based on what we're seeing. How long that will take and how patient we should be, it's going to depend on the totality of the data, how the outlook evolves.
Victoria.
Hi, Victoria Guido with Politico. You've talked about your commitment to being apolitical and nonpartisan, and I was just wondering, given that it's an election year, is the bar for rate changes higher close to an election? And similarly, is there a significant economic difference between, starting to cut in, say, September versus December?
So we're always going to do what we think the right thing for the economy is when we come to that consensus view that it's the right thing to do for the economy. That's our record. That's what we do. We're not looking at anything else. It's hard enough to get the economics right here. These are difficult things, and if we were to take on a whole nother set of factors and use that as a new filter, it would reduce the likelihood we'd actually get the economics right. So that's how we think about it around here. And we're at peace over it. We know that we'll do what we think is the right thing when we think it's the right thing, and we'll all do that. And that's how everybody around here thinks. So I can't say it enough.
Okay, so that resistance at 25 is holding for now. That means the market likely needs to pull back a little bit. I'm looking for support around 5110, 5106, and lastly 5100. Support at any of those levels. We'll turn around and head back up to get above that L period high. If they don't get support, that will be the high of the day. So that was all the short covering. Now we need the new FOMO buyers to step in if they want to keep this momentum going. Looking for support.
Fourth presidential election here. Read all the transcripts and see if anybody mentions in any way the pending election. It just isn't part of our thinking. It's not what we're hired to do. If we start down that road, I don't know how you stop. So.
Simon.
Thank you, Chair Powell. Question about the labor market. You've mentioned a few times that the labor market is normalizing. Certainly today's JOLTS data suggested that things are kind of getting back to pre-pandemic levels. One thing that hasn't normalized is wage growth, which is still quite a bit stronger than before the pandemic. I wonder if you can share your analysis of why that's happening. Is it a lagging indicator or something else going on?
So I think if you go back to where wages peaked, wage increases peaked a couple, 3 years ago, essentially all wage measures have come down substantially to that. But they are not down to where they were before the pandemic. They're still roughly a percentage point higher. And we've seen pretty consistent progress, but not uniformly. And you'll note the ECI reading from Tuesday was expected to have come down, and essentially it was flat year over year, I think, roughly. So, yeah, I mean, that part of it is bumpy. And again, we don't target wage increases, but in the longer run, if you have wage increases running higher than productivity would warrant, and then there will be inflationary pressures. Employers will raise prices over time if that's the case. So we've seen progress. It has been inconsistent, but we have seen a substantial decline overall. But we have ways to go on that.
Scott. Your word. Nancy. Nancy. Sorry.
Hey, Chair Powell, Nancy Marshall-Genzer from Marketplace. You mentioned consumers, and consumers are feeling the weight of interest rates right now. Mortgage rates are up, as are rates for car loans, credit cards. People looking to borrow are very discouraged. That's reflected in their views on the economy. What would you say to them?
Well, the thing that hurts everybody, and particularly people in the lower income brackets, is inflation. If you're a person who's living paycheck to paycheck and suddenly all the things you buy, the fundamentals of life go up in price, you are in trouble right away. And so with those people in mind in particular, what we're doing is we're using our tools to bring down inflation. It will take some time, but we will succeed, and we will bring inflation back down to 2%, and then people won't have to worry about it again. That's what we're doing, and we know that it's painful and inconvenient, but the dividends will be paid will be very large, and everyone will share in those dividends. And we've made quite a lot of progress if you can think about it. I think headline core PCE peaked at 5.8. Now it's at headline peaked at 7.1. Now it's at 2.7.
Here you go, Jan. If you want those settings for the volume dots, there you go. Clustering by 50, minimal display volume 300.
I think that restrictive monetary policy is doing what it's supposed to do, and it's also in this case unusually working alongside and with the healing of the supply side. That was different this time was that a big part of the source of the inflation and the reason why we're having this conversation is that we had this supply side kind of collapse with shortages and bottlenecks and all that kind of thing. And this was to do with the shutting down and reopening of the economy and other things that really raised demand. So many factors did that. So I think now you see those two things working together, the reversal of those supply and demand distortions from the pandemic and the response to it, along with restrictive monetary policy. Those two things are working to bring down inflation, and we've made a lot of progress. Let's remember how far we've come. And we have a ways to go. We've got work left to do, but we're not looking at the very high inflation rates that we were seeing 2 years ago.
Courtney Brown from Axios. Thanks for taking our questions, Chair Powell. I wanted to follow up on something you mentioned earlier on housing inflation. There's kind of been this long-awaited disinflation in shelter that still hasn't arrived. So I guess two questions. How do you explain the substantial lags between some of the private sector data we're seeing and the government data? And how confident are you that rents will be helpful on the inflation front in the coming months?
So essentially, there are a number of places in the economy where there are just lag structures built into the inflation process, and housing is one of them. So when you have when someone a new person goes to rent an apartment, that's called market rent, and you can see market rents are barely going up at all. The inflation in those has been very low. But it takes, before that, they were incredibly high. They sort of led the high part. So what happens is those market rents take years, actually, to get all the way into rents for tenants who are rolling over their leases. Landlords don't tend to charge as much of an increase to a rollover tenant for whatever reason. And what that does is it builds up a sort of an unrealized portion of increases when there have been big increases. And what happens is, it's complicated, but the story is it just takes some time for that to get in. Now, I am confident that as long as market rents remain low, this is going to show up in measured inflation, assuming that market rents do remain low. What will be the exact timing of it? I think we've learned that the lags are longer. We now think significantly longer than we thought at the beginning. And so confident that it will come, but not so confident in the timing of it. But yes, I expect that this will happen.
Thanks.
Nick Jasinski.
Thank you, Chair Powell, for taking the questions. This is Nicholas Jasinski from Barron's Magazine. It seems that over the past 3 or 4 years, economies and central banks in developed markets at least have been on more or less the same trajectory, easing during the pandemic, fighting inflation with restrictive policy on the way out. Feels like that may be ending in 2024 based on some of the economic data from Europe and the US and Japan and statements from those central banks as well. So my question is, what considerations or risks does a period of more divergent global economic trajectories and central bank policies present for the FOMC?
So you're right. I think that may happen, and you know that we all serve domestic mandates, right? So I think the difference between the United States and other countries that are now considering rate cuts is that they're just not having the kind of growth we're having. Their inflation is performing about like ours or maybe a little better, but they're not experiencing the kind of growth we're experiencing. So we actually have the luxury of having strong growth and a strong labor market, very low unemployment, high job creation, and all of that. And we can be patient, and we'll be careful and cautious as we approach the decision to cut rates, whereas I think other jurisdictions may go before that. In terms of the implications, I think obviously markets see it coming. It's priced in now, and so I think the markets and economies can adapt to it. And I think we haven't seen, in addition for the emerging market economies, we haven't seen the kind of turmoil that was more frequent 20 years ago, 30 years ago. And that's, I think, partly because emerging market countries, many of them have much better monetary policy frameworks, much more credibility on inflation. And so they're navigating this pretty well this time.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You sort of backed away from the notion that the economy would need to encounter pain for inflation to come back down. But given sticky inflation data in the first quarter, can disinflation still happen along a relatively painless path for the economy, or is some softening in the labor market and the economy likely needed to bring inflation back down?
So you're right. I think we thought, and most people thought there would have to be probably a significant dislocations somewhere in the economy, perhaps the labor market, to get inflation all the way down from the very high levels it was at the beginning of this episode. That didn't happen. That's a tremendous result. We're very, of course, gratified and pleased that hasn't happened. And if you look at the dynamics that enabled that, it really was that so much of the gain was from the unwinding of things that weren't to do with monetary policy, but the unwinding of the distortions to the economy, supply side problems, and also some demand issues as well. The unwinding of those really helped inflation come down. Now, as I've said, I'm not giving up on that. So I think it is possible that those forces will still work to help us bring inflation down. We can't be guaranteed that that's true, though. And so we're trying to use our tools in a way that keeps the labor market strong and the economy strong, but also helps bring inflation back down to 2% sustainably. We will bring inflation down to 2% sustainably. We hope we can do it without significant dislocations in the labor market or elsewhere.
And speaking of dislocations in the labor market, in terms of cutting, you said if there were weakness in the job market, that could be a reason to cut rates. So if the unemployment rate were to tick above 4%, but inflation not back down to your 2% target, how would you look at that? Would the unemployment rate popping back above 4% catch your attention?
I said an unexpected weakening is the way I characterize it. So, and I'm not going to try to define exactly what I mean by that, but it'd have to be meaningful and get our attention and lead us to think that the labor market was really significantly weakening for us to want to react to it. A couple of tenths in the unemployment rate would probably not do that, but it would be a broader thing that would suggest that it would be appropriate to consider cutting. And I think whether you decide to cut will depend on all the facts and circumstances, not just that one.
Chair Powell, thanks for taking the question. Kyle Campbell with American Banker. You've said that broad and material changes are needed for the Basel III endgame proposal, and you've mentioned that a reproposal is something that's on the table. As you've had more time to sort of sit with the public commentary, process that, and understand the options available to you, do you have a better sense of whether a reproposal will be necessary? And do you have a timeline in mind for when some sort of movement will be made on that front, either a reproposal or a move to finalize?
So let me start by saying that the Fed is committed to completing this process and carrying out Basel III Endgame in a way that's faithful to Basel and also comparable to what the other large comparable jurisdictions are doing. We haven't made any decisions on policy or on process at all. Nothing. No decisions have been made. I'll say again, though, if we conclude that reproposal is appropriate, we won't hesitate to insist on that.
And then do you need to resolve issues with the capital proposal in order to advance other parts of the regulatory agenda, or do you expect to continue to make progress on those other agenda items?
There's no mechanical rule in place there, but I would say that the Basel III process is by far the most important thing, and really is, I think, occupying us at this time in terms of what we're moving ahead with.
Let's go to Mark for the last question.
Thank you, Mark Hamrick with Bankrate. Mr. Chairman, what can you tell us about the approach that you take with your role in the sense of trying to achieve consensus, which you recently identified as a priority, while allowing for a range of views or even dissent? We don't see many dissenting votes in the official statements, even when more spirited discussions are noted in the minutes after the fact. How do you avoid groupthink and avoid a higher risk of a policy mistake? Thank you.
So I think if you listen to, and you all do, listen to my 18 colleagues on the FOMC, you'll see that we do not lack for a diversity of voices and perspectives. We really don't. And it's one of the great aspects of the Federal Reserve System. We have 12 reserve banks around the country where they have their own economic staff, not the people who work here at the board. They're different people, and so each reserve bank has its own culture around monetary policy and its own approach and that kind of thing. It guarantees you a diversity of perspectives. So I think that the perspectives are very diverse. But and in terms of dissents, we have dissents, and a thoughtful dissent is a good thing. If someone really makes you think, that kind of thing. But all I can say from my standpoint is I listen carefully to people. I try to incorporate their thinking, or do everything I can to incorporate their thinking into what we're doing. And I think many people, if they feel that's happening, that for most people, most of the time, that'll be enough. But I'm not. It's not frowned upon or illegal or against the rules or anything like that. It just is the way things come out. And I think we have a very diverse group around the people, frankly, more diverse than it used to be in many dimensions, more diverse from the obvious gender and demographic ways. But also we have more people who are not PhD economists. So we have people from business and law and academia and things like that. So I think you actually do have quite a good diverse perspective. I think all of us read these stories about a lack of diversity, and we look around the room and say, I don't understand. I really don't understand what they're talking about. So, but I get the question, though. Thank you very much.
That's all, folks. All right. Well, the momentum is over. It generally only lasts until he's done speaking. We got some potential support here in this large cumulative node around 5103 and 5095. I would suspect the market is just going to rotate around here on the upper end of the range for the rest of the day. There is always a chance that new buying could break that L period high, but I think we might be done for the day. That might be the high. And there's, of course, also always a chance the market starts to pull back to retrace the single prints we left behind in the K period here. But again, that seems less likely to me. The market did a lot of work to get up here. I suspect they're going to want to hang out for a bit. So looking for support. 5103 or 5095 for some sideways chop. Here we go. Fighter Pilot says, I've subscribed. I'm a Brigade member, and I pushed the like button. Have you? Yeah, if you guys enjoyed me making the call down here when we were still inside the overnight range that the move would be to the upside, please smash that like button. If you're new to the channel and you don't know what's what, I run a community called the Pirate Traders Brigade. You can find us at piratetraders.io. We'd love to have you. And lastly, but most certainly not leastly, if you're newer to trading and you want to learn how to read the two-way auction process, you want to learn how to read Bookmap and market profile software and market internals to give you an edge in your trading, consider checking out my workshop, marketsandmind.com. With that, I will sign off and say farewell to all. As I said, I think we're just going to rotate around in the upper end of the range here. There is a chance we head lower, but I don't think that's what's going to happen. So I wish you all the best of luck, and we will see you tomorrow morning. Thanks a lot.